Hey, Chris Miles here, anti-financial advisor. Hey, many people ask me, what's the difference between your policies? How is yours different than like the traditional policy? Because if you're not like a whole life insurance agent, you really don't know the difference. But I'll tell you, there is a huge difference. Now, when I was sold infinite banking about 15 plus years ago, I was told by that insurance agent, hey, this is just the way it is. Get used to it, right? So what I'm going to show you is looks like this. Okay, so this is like the policy I bought in 2006. So this insurance agent, he told me, Chris, this is how you do it. Put in $1,000 a month. Now, there won't be any cash value. The cash value right here, that total cash value is an important thing to pay attention to. He said that total cash value is going to be zero for the first 2 years. That's normal. It's front loaded cost, which is true. But after a while, it starts to pay for itself, where by year 5, look, now it's growing by more than what you're putting in. And I said, cool. Sounds great. Now I asked him this point blank. I said, can I overfund this policy? Because when I was a financial advisor before, even though I hated whole life, I didn't know I have a good reason. I was just told to hate whole life. I was selling universal life. And in that kind of situation, I knew you could do some things to adjust it and put in more money to have more cash value. This guy, this insurance agent said, no, you cannot overfund it. You cannot do that. Don't even touch it. Okay. I said, okay, fine. I don't want to trigger taxes. You're right. You know better. You're the whole life expert. I'm not. Well, in that third year, I just started to get some money in. I'm paying $1,000 a month. I had a few $100s in there. And then all of a sudden, the recession hit. I couldn't afford to keep paying $1,000 a month because I was in the hole. I was nickel and dime and everything. Well, because I didn't have the money to pay that $1,000 a month premium, which was the minimum I had to pay to keep it active, I lost it. I put in over $25,000 to only have a few $100, and it was gone. Just like that, lost the policy. I was sad. I found out a year later that insurance agent lied. You can actually do something which is called paid up additions, which is the overfunding part of it. So what makes ours different? We do paid up additions over the next several years, really next 12, 13 plus years. I started really finding ways to get the max ROI out of these policies possible, so that when you put this money in, it looks better. Notice here, even by the fifth year, I don't even have half my money back. I paid in $60,000 only to have 28,000. And notice it takes me 13 years before I finally have as much as what I paid into it. I paid 156,000. I have 158,000 by year 13. By the way, this is good. Most whole life policies, if you do these base premium traditional whole life policies, they take you at least 15 to 20 years. The worst case one I've seen was almost 40 years before you break even. Needless to say, that person got out of that one fast. Here's what ours looked like in the same exact example. Now, here's one thing I didn't know either. If you pay monthly, this is a big tip. If you pay monthly, you are paying more in cost, therefore paying the insurance agent more money. So if they keep pushing you monthly premiums, it's because they make more money. You actually pay less if you pay it annually. Now, some of you may not be able to do that. That's fine. But in many cases, because the way we design it, there's a minimum and a maximum. So in this case, I make the maximum $12,000. That's still true. But the minimum on this, so the minimum is 2,000, but I can put in up to $12,000. I'm only required to put in 12,000 a year. Look at the difference. Instead of zero in the first year, I've got almost 10,000. Second year, I've got 20,000. Look, by year 5, I've got almost exactly what I paid into it, about $60,000. I about broke even. That's usually the goal. By the way, if you're in your late 20s, this is the age I was when I was buying these policies. If you're in your 20s, it tends to be a little bit more expensive because you guys are a little bit crazy. You get a little wild and crazy and you're a little high risk. Once you get into your 30s, guess what? These ROIs go up better. So believe it or not, even in your 30s, you can actually get the best ROI possible. Even your 40s and even 50s, sometimes you can get really good returns. 60s, these returns go down, but if you're in great health, they still work amazing. So notice I've got more. So it's not like I have 28,000. I've got more than double this cash value already by year 5 and so on. The cool thing is I can actually stop paying in these kind of plans by year 7. So after year 7, I can just stop paying completely. Or in any of those years, I don't have to pay 12,000. If I have a rough year like what happened during the last recession, my minimum that I actually have to pay is only $2,000 a year. What's cool about that is if I have at least $2,000 in cash value, which you can see here, even in day 1, I've got that money. I can just borrow from that policy, pay it right back in, because pretty much by the third year, it's paying for itself anyways. So a massive difference. Just to give you another example, here's the difference between the rate of return overall, if you see the big picture. Okay, so see here on the old policy, the one that I was sold, right? Look, I mean, even 5 years, like I said, 28,000, you don't even really have a positive return till like, 15 years in. I've got 200,000 after paying 180. The top that I get to is about 4.5% after I've stopped paying into it. And just look at this too. Look at year 40, age 68, right? So if we're looking at it from a retirement perspective, I have 1.2 million with a $1.9 million death benefit, almost 2 million. Now, the insurance agent, he tried to argue with me. I actually cornered him. I actually sat down with him for 2 hours, had a debate. I showed him how to do this. And he said, no, Chris, it's not that good because you don't have as much death benefit, which is true in the beginning. If you notice in the beginning here, my death benefit's 371,000 in year one right there, right? Well, this one, you've got like 1.1 million. So he's right. He had more death benefit. But remember, age 68, I have 1.9 here. Guess what age 68 has here? $2.2 million. So even though he said that he's got 1.9 million, look, I've got more money in here. Well, guess what? I've got a bigger death benefit and I've got almost 1.4 million of cash. What did his have? It had 1.2 million. I've got $200,000 more and I have a bigger death benefit. And I showed that to him. I said, look, even shorter term, we eventually catch up and have the same death benefit. And I have even same cash value at some point, even though it's more overall. But I'm like, look, I've got more cash value and I end up matching your death benefit eventually. So what? You know what his answer was to me? He said, Chris, the reason I don't do it is because I can't afford to cut my commissions that way. That right there is the reason I never did business with him again, never sent him another referral. In fact, we started to do this ourselves over the next decade, started to perfect it and get it better and better and better. That right there. Here's a stupid thing about that. That's a scarcity mentality, so dumb that they're like so feared that they're going to lose out on their commissions. Some of them, we blend things. They'll say like, hey, you need to do a 60-40 split where 60% is in cash value, 40% goes to cost, where mine's more like an 80-20 split. That's dumb. They just do that because they want to make more commissions. And like, it doesn't cut from you that much. We make more, you don't make much less. So it's still a win-win, right? Wrong. Every single time, this is our promise, every single time we will get you the best ROI in any situation. Any situation. Hands down, we don't mind going toe-to-toe with anybody to show that because we know our numbers will come out on top. At best, the 0.01% of people, of insurance agents that might actually match our numbers or get close. That's about it. But we will beat those numbers every single time when it's apples to apples comparison. And that's what drives me nuts because those guys have such scarcity mindset. They think they cannot afford to live off that. The great news is, guess what? We cut our commissions down the minimal amount, which the insurance costs go down the minimal amount, which is what you're paid on as an insurance agent. Insurance costs are cut down. But as a result, guess what our clients do? They pay more into them. That's the abundance mentality. Because, I had one guy that owned a real estate company. He was only putting in $6,000 a year, but that insurance agent set it up just like the original insurance agent set up on mine. After 6 years, he said, Chris, I paid $36,000. I've got 18 grand. This is a joke. And I said, I told you the guy's a schmuck. I told you, even though he talks infinite banking, he's not really someone that does good infinite banking. So we switched him. He's not doing $6,000 a year. He's doing over $50,000 a year into his plan. Why? Because he knew from day one, he would have $40,000 in there. He knew he had money in there. It wouldn't be like waiting a third year before you finally have a few $100, right? That's the difference. By the way, we ended up making more money in commissions than the other guy did because we did what's right for the client. That's what's important, guys, is that you need to make sure it's done right for you. How do you know? Use us as a way to compare, shop us to anybody if you want. Shop around. I welcome it. I welcome anybody challenge toe-to-toe if it's actually apples to apples. There have been times people come back and say, it can't beat your numbers. No, they cheated on this or they cheated on that. That's not true. So guys, that's our promise. If you've got questions, reach out to us at moneyripples.com, but know that it's got to be the right kind of infinite banking. Straight premium, base premium whole life doesn't work unless maybe you're a lot older and you need a bigger death benefit. But here we try to do it with a minimal death benefit to get the maximum amount of cash in to get you the best return possible so that you have the ability to earn money in two places at the same time. You can double dip on your returns whenever you invest that money outside of the whole life insurance policy. Go visit us at moneyripples.com. Make it a great day.